Welcome to TalkTickers.
Good to be here.
Today we are doing something a little different. Usually we're deep in quarterly earnings or looking at macro trends, but today we're zooming in on a very specific arbitrage opportunity in the real estate market. We're sitting here in January 2026. The Fed has, done its thing and rates have stabilized, but they've stabilized in that kind of sticky, painful 6 to 7% range.
Which historically is actually pretty normal. But psychologically, for anyone who remembers 2021, it feels like a crisis.
Exactly. And that memory of 2021 is what we are digging into. Because what if I told you there's a legitimate legal way to basically fire up a financial DeLorean?
I like that.
Way to reach back into the past, specifically 2020, 2021, and grab one of those, 2.5% or 3% interest rates for a purchase you make today.
It sounds like some kind of financial alchemy, or maybe a scam you'd see on a late night infomercial.
It does, but it's actually just contract law. We are talking about assumable mortgages.
And we should be clear, this isn't some niche little trick.
No. Before anyone tunes out, we're not talking about saving a few bucks a month. We're talking about unlocking hundreds of thousands of dollars in value. We're talking about solving the inventory crisis. And we're talking about a process that, frankly, banks absolutely hate.
Oh, I hate it because it hits their bottom line.
But for a savvy buyer in this 2026 market, an assumable mortgage is maybe the single most valuable asset a house can have. Better than a new roof.
Better than a pool.
Way better than a pool.
Okay, so let's unpack this. We need to get into the mechanics, the risks, and this thing called the assumption gap, which is where most of these deals just die. But let's start at the top. What exactly is an assumable mortgage?
Well, at its core, it's a transaction where the buyer doesn't just buy the house, they literally buy the debt. You're taking over the seller's existing loan.
The whole thing.
The whole thing. The exact remaining balance, the repayment schedule, and most importantly, the original interest rate. You are stepping right into the seller's shoes. So, to be crystal clear, if a seller locked in a 2.75% rate in 2021, and I buy that house today, I get that 2.75% rate for the rest of the loan.
You do. The lender basically crosses out the seller's name on the paperwork and writes in yours.
Which is just a massive deal right now. I mean, we saw rates go from 3% to almost 8% in late 2023, and now are settling in the high 6s. That spread is enormous.
It's pure wealth transfer. But we have to address the elephant in the room right away, because if this were easy, every single listing would be doing it. Why isn't every mortgage assumable?
And that brings us to the due on sale gorilla.
Right. The due on sale clause. Most conventional loans, think Fannie Mae, Freddie Mac, they have this clause buried in the contract.
Paragraph 17 or 18 usually.
Exactly. And it says the moment the property's ownership transfers, the entire loan balance is due. Immediately.
Which, of course, kills the assumption the bank isn't going to let you keep a 3% loan when they could force you to pay it off and then lend that same money out to someone else at 7%.
It's all about their yield. But the government plays by different rules. And there are three main types of loans where assumption is a built-in feature.
Okay.
First, you've got FHA loans. Federal Housing Administration, fully assumable. Now, since '89, buyers do have to qualify for them, credit check, income, the whole thing, but the mechanism is there.
And FHA loans, those are for owner-occupants, right? You can't just be an investor scooping these up from afar.
Generally, yeah. You need the intent to occupy it as your primary residence. But there's some nuance. If you live in it for a year, you can often then move out and turn it into a rental with that amazing low rate locked in.
Interesting. Okay, what's next?
Then we have the big one, VA loans, Veterans Affairs.
And I think I know the biggest misconception here. Most people think you have to be in the military to assume a VA loan.
Correct. And that is completely false.
Wow.
You do not have to be a veteran to assume a VA loan. A civilian buyer, someone who has never served a day in their life, can assume that veteran's mortgage.
That opens up a huge pool of inventory. We'll come back to the risk for the veteran seller later because I know there's a big trap there.
There is. And finally, you have USDA loans, Department of Agriculture. They're assumable, but they have much stricter income and location limits, so they're a smaller piece of the pie.
So if you add all that up, what are we looking at? The data shows something like 23% of active mortgages are assumable.
It's about 12.2 million loans. That's not a niche. It's almost a quarter of the market.
And we're only just now talking about it because for the last 40 years, rates were always falling.
Right. Why would you want to assume a seller's 8% loan from 1995 if you could get a new one for 4%? The value proposition was completely flipped.
Until 2022, when rates doubled. That created what we call the lock-in effect. Homeowners with 3% rates looked at the market, saw 7%, and just said, nope, I'm not moving.
And inventory just vanished. Assumable mortgages are really the key to unlocking that inventory. It lets a seller transfer that low-rate debt as an asset instead of just extinguishing it.
Let's talk about it as an asset then. Because a 2.75% mortgage in a 7% world has a real, tangible value. Sellers should be pricing this in, shouldn't they?
They absolutely should, and the data shows they are. Properties marketed with an assumable loan are selling for a premium around 5% higher than comps.
So on a $400,000 house, that's an extra $20,000.
Exactly.
But hold on, as a buyer, why would I pay $20,000 over market value? That sounds like I'm getting a bad deal right out of the gate.
You have to run the cash flow analysis. Let's just look at the raw numbers. On that $400,000 loan balance, what's the difference between 3% and 7%?
It's huge.
In principal and interest, a 7% loan costs you about $2,660 a month. That same loan at 3% is roughly $1,680.
Okay, so that's almost $1,000 a month in savings.
Right, $12,000 a year. So if you pay that $20,000 premium up front,
I make that back in less than 2 years.
exactly. And over the life of the loan, you're looking at over $100,000 in interest savings, paying $20,000 to save $100. That is a highly rational investment.
Okay, but now we have to hit the brakes. The big one, the assumption gap.
This is where 90% of these deals fall apart.
Right, because the seller has been paying down their loan and the house has appreciated in value. So let's paint a picture. I want to buy a house for $500,000. The seller's remaining loan balance is only $300,000. If I assume their loan, I'm taking on $300,000 of debt, but I still owe them $200,000 for their equity.
Yes.
Right.
You have to cover that $200,000 difference. That's the assumption gap. And you cannot, I repeat, cannot add it to the assumed loan. That loan is a sealed capsule.
So option one is cash. If you have $200,000 sitting around, you just write a check. But most buyers don't have that.
Most don't. So then you look at secondary financing, getting a second mortgage or a HELOC to cover that gap.
But this is where people get hung up. They say, well, wait, if I get a second mortgage for that $200,000 and the rate on that is, say, 9% or 10%, doesn't that just ruin the benefit of the 3% loan?
It dilutes the benefit, but it almost never ruins it. You have to calculate the blended rate.
Okay, let's run that math.
Stick with our example. You have the $300,000 loan at 3%. You have a $200,000 loan at 9%. You take the weighted average of those two.
And your effective interest rate on the total $500,000 comes out to what, somewhere in the fives?
About 5.4%. And since the market rate for a brand new loan is almost 7%.
You're still beating the market by over 150 basis points. That's still a huge win.
It's a huge win. You're just not winning quite as big as if you paid all cash for the gap. The trick, though, is finding a lender willing to give you that second mortgage.
Why is that a problem?
Because that second lender has to agree to be subordinate. If you default, the first mortgage, the one at 3%, gets paid back first. The second lender gets whatever scraps are left. It's riskier for them, so you often have to go to local credit unions or specialized lenders.
There's also the seller carryback option, which sounds fascinating.
This is the creative investor's favorite tool. The seller basically acts as the bank for that gap. Instead of you paying them the $200,000 in cash, they agree to let you pay them monthly over maybe 5 or 10 years.
So the seller becomes a lender.
Yes. It works best for sellers who don't need all their cash immediately. Maybe they're downsizing or they're investors who want an income stream.
Okay, so we've covered the why and the how. Now let's get to the risks. The whoops moment. We mentioned the VA entitlement issue. Let's go deep on that because that sounds like a serious trap.
It is a massive trap for the veteran seller. We said a civilian can assume a VA loan, and that's true. But the VA guarantees these loans based on a veteran's entitlement. It's like a finite bucket of eligibility.
So if a veteran sells to another veteran,
the buyer can substitute their own entitlement. It's a clean swap. The seller gets theirs back and can go get another VA loan on their next house.
But if they sell to a civilian like me,
you don't have any entitlement to swap in. So the veteran's entitlement stays tied to that loan until it is paid off in full.
Wait, so even though they don't own the house anymore, their VA benefit is stuck there?
Stuck. which means when that veteran seller goes to buy their next place, they might not be able to get a new VA loan. They're effectively blocked from using the benefit they earned.
Yeah. That's a deal killer. They need to know that going in.
If you're a veteran seller, you have to ask, is my buyer a veteran who can substitute their entitlement? If the answer is no, you are burning your borrowing power.
Wow. Okay, let's shift to the operational side, the actual process. I hear it's not exactly speedy.
It is a bureaucratic nightmare. I mean, you have to understand the incentives. The loan servicer, the company you make payments to, they only make a tiny fee for processing an assumption. Maybe $1,000.
So they're doing all the work of underwriting a new loan credit checks, income, all of it for a fraction of the profit.
Exactly. And the investor who actually owns the loan is losing money because their capital is stuck at 3% instead of being reloaned at 7%. The entire system is incentivized to fail.
And that's where we get the slow walk.
That's the term for it. Files get lost. Calls don't get returned. A normal mortgage might close in 30 days. For an assumption, you need to budget 60, 90 days, sometimes longer. You cannot be passive. You have to bird dog it every single day.
There's one other area where these are critical that we haven't touched on, divorce settlements.
This is huge. In a divorce, one spouse often wants to keep the house. Normally, they'd refinance to get the other spouse off the mortgage. But in 2026, that means trading a 3% rate for a 7% rate.
Which could make the house totally unaffordable for the person trying to stay.
Exactly. An assumption is the lifeline. But there's a key distinction. A simple assumption just adds the one spouse, but the departing spouse is still technically on the hook if things go wrong.
And they don't want that liability hanging over their head.
No. They want what's called a qualified assumption. That comes with a formal release of liability. The remaining spouse has to requalify on their own, and if they do, the departing spouse is completely cut loose. It's vital for protecting their credit.
That phrase, release of liability, seems like the absolute linchpin here for any kind of sale.
It is the single most important legal document in the whole process.
Which brings us nicely to our final summary, the one question. If you're looking at one of these deals, buying or selling, what's the one question you have to ask?
It's really a two-part question. Does this deal include a formal release of liability? And exactly how is the assumption gap being financed?
Let's break down why that specific combination is so critical.
Well, without the release of liability, the seller is basically co-signing a loan for a stranger. If the buyer defaults, the seller's credit gets ruined. It's that simple. And without a solid mathematical plan for the gap cash, a second loan, seller financing, the deal is just a fantasy. The low rate doesn't matter if you can't actually pay for the rest of the house.
The rate is the hook, but the gap is the boat. You need the boat to catch the fish.
That's a perfect way to put it.
So to recap, assumable mortgages are the DeLorean of real estate. They let you travel back to 2021 rates in a 2026 market.
It's one of the few true arbitrage opportunities left. You're arbitraging the cost of capital.
But it comes with real friction. You have the assumption gap, the slow walk from servicers, and for veterans, that critical entitlement trap.
It's not for the faint of heart. But if you're willing to navigate the bureaucracy, the return is undeniable. That interest savings is one of the highest yield moves you can make in housing right now.
You're effectively buying $1 for 50 cents. You just have to wait 3 months in line to pick it up.
Precisely. And in this market, that line is worth waiting in.
Before we sign off, I want to leave our listeners with one final thought. We talk a lot on this show about assets being tangible things, factories, product lines, or in this case, the bricks and land of a house. But in a highly financialized economy, the debt structure itself is an asset.
That's a really important shift in mindset.
If you're a seller sitting on a 2.5% loan, stop giving that away for free. It has a monetary value. And if you're a buyer, maybe you should start looking for the debt before you look for the kitchen. You can always change the kitchen.
Well said.
That's it for this deep dive from TalkTickers. Thanks for listening.